Greetings, everyone, and thanks for tuning in to this presentation on the Augusta Rule, brought to you by Downing and Morano CPAs, located in Austin, Texas. While Downing and Morano excels at tax compliance and tax preparation, what separates us from other CPA firms is that we have the ability to match your unique financial situation to the Internal Revenue Code to identify and to implement legal tax strategies that can lower your tax bill. So let's look into what exactly the Augusta Rule is. It's a fun strategy that few business owners are taking advantage of. It's a code-based strategy built on a loophole that lets you rent your home for up to 14 days tax-free, with a twist that lets you rent it to yourself. Code Section 280 AG says that if you rent your residence for less than 15 days per year, you can't write off any expenses attributed to that use, but you also don't have to include that rent in your income. For years, homeowners have taken advantage of this rule to pocket tax-free income when special events roll into town. It's called the Augusta Rule because if you live in Augusta, Georgia, and you're not a golf fan, you can rent your home to people coming into town to watch the Masters golf tournament every April. The same principle works for similar events. If the Super Bowl, the Olympics, or a national political convention come into your town and you can find someplace else to stay for a while, you can take advantage of this rule as well. The problem with all those choices is that they involve renting your home to strangers who may or may not respect your home the way you do. Fortunately, as you'll see in the language of Section 280 AG, there is no requirement that you rent your home to strangers. That means you can rent your home to your own business. Deduct the rental payment from the business like any other rent you'd pay and pocket the income tax-free on your personal return. In other words, take the money out of one pocket where it's deductible and put it in another pocket where it's non-taxable. That sounds pretty nice, right? Of course, there are limits right there in Section 280 AG, 14 days. The plain language of this statute also specifies using a personal residence. So, if you're fortunate enough to have more than one residence, I see no reason why you can't take advantage of this rule more than one time in 1 year. Finally, your business has to be a separate legal entity. So, from a tax perspective, a sole proprietorship is indistinguishable from you, and you can't rent the house to yourself. As with most deductions, you have to dot your I's and cross your T's to make this work. The first requirement involves qualifying rental occasions. Code Section 274 A1B, also known as the Entertainment Facility Rule, disallows deductions for facilities used for entertainment, recreation, or amusement. That means you can't rent your home to your business just to throw a party. However, there are still plenty of other occasions to host at your home. Annual shareholder meetings, director meetings, off-site employee retreats, client events where any meal or entertainment you serve are incidental to the client event. I had one case where a real estate agent represented a custom home builder. The builder didn't do enough business to justify building and maintaining a model home, but my client lived in one of the builder's homes. So once a month, my client rented his home to his LLC to hold an open house to show off the builder's work. That created 12 qualifying rental occasions. You also have to pay a fair market value for the rent. You can't just say your house is worth $5,000 a day and call it good. So how do you determine the correct amount? You can go online, search through Airbnb listings, and see what comparable landlords are asking for their homes. Or you can call local meeting spaces to determine what they charge for similar space. Here, we take 20% of the home's monthly rental value as listed on Zillow.com. You might think it's excessive to take 20% of the monthly rental rate for 1 day's use, but the Zillow rental rate still leaves you on the hook for furnishing the home, setting up the utilities, and filling the fridge with snacks. Needless to say, there's no case law here, So be sure to show you've done some homework and you feel comfortable signing a tax return that deducts that amount. If your business pays you more than $600 in rent, you should report that payment in Box 1 of Form 1099 Miscellaneous. Of course, now the IRS will know you're getting that income. So how do you report it without paying tax? You'll include it on Schedule E, page 1, where you'd report any other real estate rental. Drop the gross rent in line 1. Then, in other deductions, include the same amount and note it as non-taxable under Code Section 280AG. Voila! Your net result is no taxable income. By the way, this strategy has nothing to do with the home office deduction. You're renting out the part of your home that you don't use as an office. So there you have it. That's the Augusta Rule, a simple way to deduct the rental expense on your business and then report the rental income on your personal tax return tax-free. Here at Downing Morano CPAs, we have many other legal tax strategies that you should look into. So feel free to look us up at downingmoranocpas.com or look us up on LinkedIn and Facebook.